All right, guys. We are back with another episode. I think this is episode number 21.
Wow.
Yeah, we got some guests with us today. If you guys want to introduce yourself.
I'm Chloe.
Chase here.
And I'm Matt, I guess. Yeah, I know.
Hey, Matt.
He's here every time, though.
Okay. Yeah, I know. You guys
We're
are
the
older than
special
me.
ones.
Yeah, they're the special ones. Don't pay attention to me. They're the special ones.
We're not on every time, I promise you.
So today, we're going to do a stock market special. Because your boy loves the stock market.
Whoa.
Whoa.
Whoa. And I
yeah.
think
Aren't you an expert?
I do okay. So everybody talks about on the internet, you only talk about stuff that you've done or know about, right? And I 100% agree with that. So I'll do a little background of like my stock market journey over the years. We'll kind of get into it real fast. So basically for me, I've been investing in the stock market for 7 years, from 18 years old until I'm 25.
Good for you.
So that's kind of cool. So 7 years of experience, and I've probably read at least a dozen books on it. So
Wow.
I've read a lot. Action. I've been consistent with the stock market, right? So 7 years of investing in the stock market. I've read about 12 books on the stock market. And then I've learned from a lot of different cool people. I've sat down with people anywhere from 6 figures in investments, 7 figures in investments, 8 figures in investments. So I've had a good great like group of people around me because like I've sat down with some very successful people personally one-on-one, like behind closed doors, which has been amazing, and I'm super grateful for that opportunity. And I've had a lot of experience from them. I've done 7 years. I've read a lot of books, and then I've watched a lot of people on YouTube who are multimillionaires, 100 million billionaires, right? So like I feel like I can talk on the subject, and I did a quick little thing to like help you guys and like teach you. If you do not know anything about the stock market, we're gonna go through everything right now.
Stock Market 101.
Yeah,
Here we
baby.
go,
Let's go.
Let's get it. Episode 21. Here we go. Okay, guys. All right. So first thing we're gonna talk about, the different types of investments. Okay. The first thing we're talking about is what a single stock is. We're gonna start at the freaking beginning, right?
Apple.
Great example. I was just gonna
You
ask
passed.
you. What? Yeah, you get an A+ gold star.
Gold star.
All right. So what do you guys think a single stock is?
It's exactly what you said.
Like you're buying a small piece of a company.
Boom.
You're buying a share in whatever company you decide that
That's
is
publicly
publicly
traded.
traded.
Ah,
You're
okay.
a limitless investor.
Yo.
It's based on how much you want to invest in that business, you know?
Yes, guys, that's a great answer. So a single stock is just one company. So let's keep it simple, guys. Keep it simple, stupid. Because I'm not that smart. No, I'm just kidding. I'm fine. But anyways, guys. So a single stock is just one company. So great example. We have Apple. We have Amazon. We have Microsoft. We have
Pickle time.
Pickle Time. Oh,
Pickle time eventually.
IPO coming soon. That means initial public offering. That's my new startup company.
Matt is on his way to being a billionaire.
Billionaire. Private jet. We're going to do a podcast on a private jet someday because we're cool like that.
That would be dope.
Then we have
We're going to
Epic.
land a helicopter on a golf course.
Yes, and then walk to the private jet. Anyways, guys, back to finance. All right, we're making it fun. Finance and fun should go together.
It should.
Dude, that's kind of a cool name, though.
It
Fun and
should.
finance.
Yeah. Or
Fun.
I mean,
Like, isn't the whole goal here to like get rich? You know, if we're talking about finance, right?
We want to have fun.
that's fun. Getting rich is fun.
It is.
And also, I feel like that makes it a little bit more accessible. Because for me, sometimes I hear stock market and I'm like,
boring.
Yeah.
I'm going to fall asleep.
I work at a finance company, by the way.
Matt, do you think your followers want to get rich?
Yes.
I think probably.
I think and we've had a great, fun couple minutes of this. So it's gonna be fun with finance. Guys. See, this is gonna
You
keep
can
your
make it a
attention.
series. You can make it
Yeah.
a series.
Yeah.
How to get rich with Matt.
How to get rich, or how to, yeah, that's good. I like that.
I would
Pickle time.
I would be watching that.
Invest in my IPO, meaning initial public offering, coming soon.
Give Matt all of your money.
Yes, I'm gonna go gamble it on black. No.
Pickle time.
Pickle time. No, I'm just kidding. Anyways, so guys, a single stock is just one company. Okay. Now we have share price. That's another important aspect of the stock market. So the share price is just like how many shares you want to purchase of a stock or of a fund. So let's say the stock price is $20, right? If you buy one share, you bought $20 of Apple. We're just going to make these numbers up. Don't know what the exact Apple price per share is at right now. Doesn't really matter for this example. But anyways, so you buy one share. Okay, I bought one share of Apple. It's $20. I bought 2 shares of Apple. It's $40. I bought 3 shares of Apple. It's $60. So I think we get the point at this point, right? Get it? Point. Yep. Okay, next. So we got single stock. Now, the next thing we have is a mutual fund. Now, do you guys know what a mutual fund is?
Yeah, I think a mutual fund is where a group of investors or some type of bank who has a person leading that money, that pile of money for all of these people or all of these investors. They go out and then they invest your money, into multiple, different stocks so that you're well-rounded.
What do we call that?
A mutual fund.
A diversified.
Yeah.
So
you're diversified. Yeah.
Diversified in your portfolio.
But then, mutual funds kind of ride the wave of the market as a whole. So instead of, one stock going up and down on its own and having a good year or a bad year, you're kind of riding the wave of the entire stock market, by investing into a mutual fund.
I love it.
It's investing into multiple companies. So, you're diversifying.
Your
risk
portfolio
is going down because, now you're relying on multiple companies instead of one. And, see where it goes, right?
Yes, sir. Yes, sir. I love it. Good
right here,
stuff. Hey, a little fist bump. Okay.
I'm not too good.
Hey, my man just killed that. I mean, give the mic to him. I'll let him take over the show. Just kidding. Okay.
No.
So we got single stock is one stock. Mutual fund it's mutually funded by a group of investors into 90 to 200 single stock companies. So think of it as like, okay, we have one stock, we have Apple. Or we have 90 to 200 stocks. So we have Apple, Amazon, Microsoft. Those are the only three I can think of right now. But we have 90 of those, right? Would you rather put your money into 90 or 100 or 200 billion-dollar companies, or would you rather just use one?
Definitely multiple.
Because you're more diversified.
I just want to put my money where Amazon is, honestly.
Exactly, right? Because Amazon brings in the cheese. But anyways, as they say. But anyways, so we have a single stock, we have a mutual fund. Next, we have an ETF. What does that stand for? Exchange Traded Fund. Now, a mutual fund and an ETF are very similar. The main difference between the two is a mutual fund, you purchase the shares at the end of the day, and an exchange traded fund, it happens instantly. So let's say it's $20. Like let's say there's an ETF for $20. You put the order in, you put the trade in, you right now at this second own the $20 share. You have one share ETF, right? A mutual fund, let's say you put $20 in, another difference is with a mutual fund, you can put any amount of money in. You can put $100, you can put $5, you can put $26.76 in if you really wanted to. You can put any amount of money in. An ETF, you have to actually put what the actual share price is. So if it's like $26, you have to spend $26, $51, $72 or whatever, right? So basically a mutual fund, you can put like $100 in, like whatever, but with an ETF, it has to be the exact amount of the actual share of the company. So whatever the stock is.
That makes sense. Yeah.
Right? So that's the difference. So you got single stock, you have a mutual fund, you have an ETF, and then you have a REIT. Do you guys know what a REIT is?
Which I've heard of before.
REIT?
Yes.
Can you explain that? I've looked at it and I've heard of it, but I've never understood it, to be honest with you.
Oh, well, thank you for asking.
I'm just telling you.
I have an answer, actually. So a REIT is a real estate investment trust. Real estate investment trust,
there
baby.
We go.
This is another type of stock that you can invest into. Now, the difference between a REIT and a single stock or a mutual fund is a REIT is invested in real estate instead of companies. Correct? So it's a real estate investment trust. So a single stock is Apple. A mutual fund is 90 to 200 single stocks in one fund. An ETF is an exchange traded fund, which means it's the same concept, multiple companies like 20, 50, 100 into one fund. And then you have a REIT, which is invested into real estate, usually commercial. There is different types of REIT. So there's commercial, there's residential, there's office buildings, there's hospitals, stuff like that. So basically you're buying a share, same thing. You don't have to actually buy the real estate, but you actually just buy a share of whatever. So if let's say the REIT's $20, so it's $20 a share. So you buy 5 shares, 20, 40, 60, 80, 100. So you got $100, right? You invested. Okay. A REIT is just invested into real estate instead of companies. That's the only difference. Does that make sense?
I like that one.
Yeah. So
Yeah.
you like there'll be REITs with like apartment complex in it. Let's say there's 1,000 units of apartment complexes in this REIT, meaning they have a diversified portfolio, or they're not really diversified, but there's only 3. Let's say there's 3 apartment complexes, right? And then you have 3 apartment complexes in the REIT, which then you're investing into. So that's what a REIT is. All right. Next we have index funds. Index funds, baby. All right. Index funds are just basically the stock market's way of averaging itself out. That's the best way to put it. So there's different index funds in the sectors of the stock market. So the best one I like, my favorite, is the S&P 500.
Oh yeah, okay. I know what these things are.
Yeah, so the S&P 500. Do you guys know what that is?
That's like the classic example. I feel
Hey.
Yeah, that's like where that's like the exchange in which you go to buy the stock, right?
Kind of.
Yeah.
So the S&P 500 is a specified fund with 500 large companies from America. So like it's 500 solid companies that you can invest in. So like if you have 1 share of the S&P 500, that means you own micro shares in 500 different companies.
Okay,
Cool.
okay.
Doesn't that make sense? So you're very
Yep.
diversified. And guys, diversification just means putting your eggs in multiple baskets. So when the financial people say, I have a diversified portfolio, all that means is they have a lot of money in different places
They have
in the stock
multiple
market.
friends, not just one.
Exactly. Perfect. Right? Finance for fun with Matt, Chase, and Chloe. Love it. Okay.
And pickle time.
And pickle time. IPO coming soon. Now you might ask, what's an IPO?
Yeah, Matt, tell us about your new pickle time IPO.
Yeah, so guys,
coming out.
So we're gonna raise $100 million for Pickle Time, okay? Because we're gonna invest in new manufacturing facilities. We're gonna hire new employees. We're gonna make different types of pickle flavors.
You've got to hire me as CEO, right?
Yes.
I'm
CEO. Exactly. He needs $1 million a year. Sheesh. So you guys, like I said, we got to do an IPO. What does an IPO mean? It's an initial public offering for when a private company goes public, which means I'm trying to raise capital for my business to then grow the business and then give them their capital back with returns on top.
Yeah, so how that would work then is companies like yourself would, put a IPO out there. People like us would
Go
want to
invest.
invest in that company. It could be anything from, let's say Nike. Obviously they've been out for years now, but back in the day, Nike came out with an IPO. People want to invest in Nike. We go buy the shares. Nike then takes that money, goes and invests it into new manufacturing. They make more shoes. They build their brand more. You start buying, new products. They come out with football gear. You start buying football gear. So they're taking your money and they're building their business with it, and then they're making us happy. We're making money because of them, and everyone's happy.
Everybody's
right?
happy. We all sing Kumbaya on the back.
And then they
Win-win.
get really rich, and
We're on our-
but
yeah.
they make us good product.
Exactly. What were you going to say?
Oh, I was just gonna say, it sounds like a win-win.
Yeah, right?
Win-win.
So that's what an IPO, initial public offering, is.
We
okay?
should try to get an IPO one day, Matt. If we do, we're gonna be billionaires.
Hell yeah. Love that. Yes.
I feel like there's definitely rules before you can
Yeah, I'm not.
go public. I feel like you have to hit some
You have to have sales
be honest
revenue.
with
and,
you-
huge
yeah.
numbers.
To
Yes,
be honest with
yeah.
you really don't. There's companies that are on the S&P 500, yes, but what was the other index you talked about?
There's smaller indexes.
Yeah,
I
there's
can
smaller
give you guys
indexes where you only have to be a $50 million revenue company or a $150 million revenue company.
not be $1 billion company.
There's another fund out there. I don't know what it's called. In which you can it's almost like monopoly money. There's like a celebrity behind it. They go out and they
With a big company.
it's not an ESOP. I don't know the name of it, but it's funded by individuals, celebrities behind it, and then those individuals are basically backing it because of the celebrity name, thinking, oh, this product or brand
Is better.
will get rich because Tom Brady has his name behind it. Well, in theory, that celebrity is not actually building a business. They just put their name behind it. So when the product flops, they don't care because they didn't invest anything in it. Individuals invested in it.
Facts.
So it's really weird.
Yeah.
You can lose or you can win a lot in the stock market.
Facts, yeah. So next, guys, we're going to talk about bonds real fast. There's 2 types of bonds. There's corporate bonds, and then there's government bonds. Okay, basically what a bond is just a piece of paper that says, I gave you money, and then you owe me the money back with interest.
I'm going to give you bonds right now.
Nice. Hey, thank you. I just got some.
You owe
so,
me.
So now I gave. Let's say we're gonna give a real life example here. So Chase here owns a $50 million company.
Yeah. Oh, I do.
Yes.
Woo! Okay.
Yeah. Right. So
Here we go.
and he is trying to raise capital to expand his company into other sectors. He issues a bunch of bonds, and I say, okay, here's $10,000. And then you give me a piece of paper. Oh, thank you for my bond. Now, the bond says, well, that it could be a percentage of like 3, 4%, or 5%, or 10%, or whatever. 50%, right? Who knows? So let's say I gave him 10K. He gives me a bond back. Basically, that means that bond is saying, okay, he owes me that 10K back plus interest because I gave him that money for him to scale his business. That's all it means. And then a government bond is the same thing, except you're giving it to the government for them to operate and do whatever they do with money. Who knows?
Who knows?
Yeah, literally, who knows, guys? But that's a different podcast.
Don't buy a government bond.
Yeah, government bonds. So guys, we have bonds for the government and bonds for companies. That's all that is. So that's kind of cool. So guys, those are the actual investment vehicles within the stock market. We have single stocks, one company. Mutual funds, they're mutually funded of 90 to 200 companies. ETFs are exchange traded funds, which are basically similar to mutual funds. REITs are real estate investment trusts. Basically, all that is you invest in a stock that invests in real estate. That's it. And then you have an index fund, which is definitely the different parts of the stock market, the different averages of the stock market, which we'll go over in just a sec. And then we have bonds, which are either corporate or government, meaning you're just giving them a loan and then they're going to give you your money back with interest. That's all that is. So those are the different types of actual investments we have. Now, next, we're going to go over the types of mutual funds real fast. So we have the growth and income mutual fund. Do you guys have any guesses on what that means?
Yeah, growth is where you're going to invest in the mutual fund, but you're expecting a return over a period of time, not right away, but it could be a bigger return. Whereas income is going to be something that you're just simply going to make a dividend off of and pay yourself based on, how much you're willing to invest up front. So if you're willing to invest 100K up front, you're going to get a higher dividend. Because the percentage obviously
is higher. Yep.
But if you only invest, 10K, then your dividend, the percent doesn't change, but it's based on how much you invest.
Love that. So basically, I'll go over them real fast. Growth and income is just big, boring companies. So you're investing in like huge companies like I can't even say the big, like huge companies, like multi-billion dollar companies. Then we have growth mutual funds. These are medium-sized U.S. companies. They have different market caps, meaning the amount of value they're worth. So you have like huge companies, big boring companies. You have growth, which is medium-sized. Then you have aggressive growth. These are small companies with potential, right? So they're smaller companies that aren't super high on the scene yet, but they're a little bit more aggressive and they have room to really explode over time.
That's where Pickle Time's at right now.
Yes, that is where our Pickle Time is.
You guys should get in like right now.
Exactly, guys, because it's an aggressive growth,
and we're about to blow up.
I want to see a product.
Yeah, well,
I want to taste the pickles.
Yeah, maybe we'll have to you'll have to have us on
I heard
again,
you
and we'll
say
have to
multiple
taste
flavors.
Yeah, we do have multiple flavors.
So
how about try. I don't like pickles, so can you have like a pickle-less pickle?
Yes.
Okay, cool.
Yeah. Anyway. I don't
like a pickle that isn't a pickle. I don't know.
Yeah,
figure it out.
So guys, again, we have growth and income type of mutual funds, which is just the type of companies in the fund. You have a growth, which is medium-sized companies, aggressive growth, which is small companies with potential, like Pickle Time. Then the last category is international funds. Now, international funds are just companies outside the United States. So like in Canada, in Europe, in China, in India, all those places. That's all that is. So that's the different type of mutual funds. Now, guys, you might be asking yourself, Matt, how the heck do I make money?
Yeah, how?
Yeah, tell me.
Yeah, how do you even, like, we've been going over these investments. We're like, how do you even, okay.
How do I apply this?
Yeah, how do I apply this to actually make freaking money? That's a great question, Matt. I'll answer it right now.
Matt, tell me.
All right, guys, there's 2 ways to make money in the stock market. 2 ways. Capital gains, capital appreciation, and dividends. Now, what is capital appreciation? Capital appreciation just means you bought the stock for $20. Now it's worth $25. That's all it means.
Awesome.
Yeah. So the stock price goes up in value. So you bought $20 stock. Now it's worth $25. You're rich.
Or now it's worth 10.
Or now it's worth 10, right? Depending on this. Yeah, exactly.
And you're poor.
In that theory, you would have lost 50% of what you invested.
Yes.
Well, you wouldn't have lost it until
Until
the
you
stock price
sell.
went back up.
Yeah. So you don't. So when it's down, you don't want to sell because that's the worst time because then you lose all your money, right? Ooh. Right. So capital gains is when the stock goes up in value. The stock price goes up. A dividend. The other one is dividends. Dividends are just portion of profits at the end of like a company's either month, quarter, year, and some companies do dividends, some companies don't. It's just basically how they calculate is basically like, let's say you have 10 shares of a stock, right? Of a mutual fund, right? And the dividend is $1 per share every year. Well, that means the number of shares that you own times the dividend price is how much money they're going to give you, right? So like let's say you have 10 shares and it's $1 per share, you get a $10 dividend at the end of the year, which is cool. Now that doesn't seem like a lot of money, but as you continue to build your portfolio and create bigger amounts of your portfolio has more and more stock in it and more shares, like shares, then you see that number grow over time. So there's different, like some companies do dividends, some companies don't, but capital appreciation and dividends are the two ways to make money in the stock market, right? Now, we're going to talk about rate of return real fast. Now, over the last like 72 years, the stock market has averaged about 11.2% over the last 70 years. So like if you're in a mutual fund, if you're in a index fund, if you're in a REIT, if you're in all these different vehicles, you have a good shot at making money. Now, a lot of people have a strategy of doing single stocks, which I do not like single stocks because they're riskier. Because why would I only want to put my eggs in one basket? Why not put them in 100 baskets, right? So that's kind of very important. So guys, so there's rate of return. So usually the average is like 10 to 12, but the exact average I think was like 11.7 over the last 70 years. Any
Pretty
thoughts?
good. No, I mean, it's good data.
And remember, you only lose money when you sell.
Yeah, well, something that's kind of interesting. So I work at a company that administers corporate retirement plans.
Okay.
So
Pensions?
yeah.
Okay,
Well,
cool.
pensions are kind of going away, but
They are,
essentially
yeah.
our clients are small to mid-sized companies, and we administer and record keep all of their employees' retirement funds. So we hold the funds.
Oh, cool. Yeah.
So we're a trust company, so we can act as a bank and actually hold their funds. But then also at the same time, like we have an investment advisor in-house that, will sit down with the employees and, give them advice, things like that. And one of the things I learned through him when I was setting up my own 401k at the company was that, like you said over the last 72 years, right?
Yep.
Rate of return was like 11.7%.
Yeah.
So a lot of times, like retirement saving in the stock market is a lot different because if you're trying to make money
You have to be more risky.
quickly or like day trading, that's way different. With the retirement,
It's long term.
it's long term, which honestly, like you said, over time, if you keep it in there and don't touch it, if you're in, as you get older, you want to be less aggressive with the type of funds because you don't want to risk all the money that's already in there.
Facts.
But for me, who just started building
In your 20s, you want to go all in.
You want to be as aggressive as you can because that more aggressive model over 20 years could give you like a 12 to 20% return. Whereas, those more conservative ones, which is what you want if you're closer to retirement, might give you a 1 or 2%, but you're not risking, losing
all
as
your
much
money. Yeah, facts.
That's my little 2 cents.
I love it. Yeah, no, 100%. And I think, okay, let's go over the different ways to actually invest. I'm going to go talk about 3 main ways, 2 that I don't like, and then the one that I actually do personally. Okay, the first one we hit on it, day trading. Now,
Yeah.
I'm going to give you guys the Google definition of day trading right now because I have it pulled up.
Everyone knows a day trader.
Yeah, they're crazy. Okay. What is day trading means the buying and selling of securities on the same day, often online, on the basis of small short-term price. Now, what does that mean? Basically, what day trading means is you're speculating the stock, a specific single stock, in a single day, and you're trying to make money by the end of the day by buying it at one price and selling it for more. Or shorting it, saying it's going to go down in price. It's very risky because you don't know what that stock's going to do in a day, and you usually lose all your money if you're wrong.
Yeah, sounds way too risky for me.
Exactly. So that's way
And
number
time-consuming.
one. Yeah, because you got to go to work. You got to go to the gym.
You have to watch the market like at
24/7.
every moment because it changes like this. And if you're not watching it, then you lose everything, or it could have gone back up. So you have to truly watch it.
And most day traders go broke. I'm sorry, but like it's really hard to do it and teach people
like
how to do it.
Unless you're like a pro, it's extremely hard.
And even the hedge funds out there, they try to do it too, and they fail. Most of them lose the money. And if they're the guys who like are on Wall Street actually there, and they like have their master's degree and they have 20 years experience, and they can't even get it right, what do you think you in your basement at your mom's house, you think you're gonna get it right? No.
Yeah,
Okay.
definitely
So
not.
day trading. So that's no. Number one, day trading, not a good way to invest. Number two, we have swing trading. Swing trading is basically like day trading, but you're doing it over a week, a month, 2 weeks. So swing trading is a style of trading that attempts to capture short to medium term gains in a stock over a period of a few days to several weeks. Swing traders primarily use technical analysts to look for trading opportunities. So again, same thing as
So you might track
Interesting.
you track a stock for a couple of weeks. You see, it goes up to 80, it goes back down to 70, it goes back up to 80, down to 70, up to 80, and then you buy it when it gets down to 70, thinking, it's going to go back up to 80. And then you sell it when it goes back up to 80 if it does, and if it doesn't, well, you lose money or whatever. But
Exactly.
that's the theory of how it will work.
That also is a pretty involved.
just not my thing. So there you have day trading, swing trading, and then the last one that I do, that this is what I preach and this is what I practice, is called dollar cost averaging.
Ooh.
Ooh.
Whoa.
Ooh. What
Let's
do you
hear
guys?
the definition.
Oh, I can. Okay, dollars cost averaging. My definition of it is putting money into the stock market every month over time.
And so your investments are more long term.
Correct. Because I'm gonna actually get rich and not lose all my money like day traders and swing traders. Sorry, guys.
So the money that you're putting in there, you're not necessarily touching for years.
Correct.
Yeah.
So basically, what happens is you audit. Or yeah, go for it.
Well, I was gonna say he's just okay. So let's say a stock is $50 today, but next week it's 55. The week after it's 60. The week after it's 40. The week after it's 42. It's always going up and down. So he's buying it, and he's buying $50 a month consistently. He's not buying $50 this month and then $300 next month. That messes up your dollar cost averaging. You have to be consistent. And so he'll put the same amount of money in, and he'll buy it at the same time every day or every week or every month.
Yep.
And then what it does is, obviously, if the stock is going up, well, he's buying it as it goes up, so his price is going to go up too. But as the stock goes down, he's buying it as it goes down.
It's
too.
on sale,
So
baby.
it's averaging back out. So he's not buying it when it's way up here, and he's not just buying it when it's way down here. He's buying it when it's right here, and then he can make money based on which way it goes opposite.
So I make money always, right? So
Yeah.
it doesn't. So dollar cost averaging is the safest way because basically I'm buy and hold, buy and hold, buy and hold, slow and steady wins the race.
Yeah, I feel like that's definitely just for your average
Joe.
person.
Yeah.
Probably the smartest way to go about this.
Yeah, because
Yeah, but people don't have patience.
Yeah,
We want
people
everything
don't.
now. We
We
want
want
to be
everything
millionaires now. We want a Lamborghini or this and that. Like
now.
So you
Matt
said
wants
it-
to be rich by the time he turns like 50.
Yeah. Well, I want to be rich over forever.
Well, I mean, your investment account will have millions of dollars in it just because you sat on it by the time you turn 50.
Exactly.
So are you setting aside? You set aside the same amount of money like each paycheck, and then
Yeah, it just-
once a month you put it into the investment account.
Yeah, so basically, let me break down. Let me go back into like the different accounts, and then I can break down what I do. But so dollar cost averaging is just means putting money in every month on the like just every month. Don't look at it. Don't obsess over it. Because think about this, guys. If you really want to get rich, like let's say you really want to get rich, and like you want to allocate your time as efficiently as possible, because that's all we have, right? You do not want to sit on a computer and day trade all day. You buy the S&P 500. The S&P 500 is a 500 large stocks. You're going to make money every year. You know that. You don't have to worry about it. You don't have to waste your time, your valuable time. You can go make money other ways. So people want to say like, oh, I got to do swing trading and make all this money or day trade. And it's like, no, dude, you put money in every month without you doing anything. And then you go and focus on a career, a business, a side hustle that makes you more money. So then you can invest more in dollar cost average every month, which then gets you richer faster. And then if you want to get into real estate, we'll talk about that another day. But there's different sectors. But today we're talking about the stock market. Okay. Now we're going to go over the types of accounts that exist within the stock market.
All right.
Let's do it.
So, okay, guys. So I love to start out with this analogy. We have cookies in a cookie jar.
I'm hungry.
Oh, she's hungry.
Love that.
Okay, so the cookies are the investments. The cookie jar is the account they're in.
Following.
Does that make sense? I think a lot of people get that confused. So you have the cookie. So the cookie jar is the investment account. The cookies within the cookie jar are the actual investments. Okay. Now there's different types of accounts. We're going to start out with everybody's favorite, the Roth IRA.
Oh, we hear that all the time.
And when finance, go.
Everyone's favorite.
Yeah. Why is it everybody's favorite? There's two different types. There's Roth and traditional. This is the baseline.
Weird name to me.
Yeah, right? Why do we do this? So Roth means tax-free. Traditional means tax-deferred. So when you're with a Roth, that means at the end, so it's 59 and a half. So you can open a Roth IRA. That's the cookie jar. That's not the cookies. Okay, guys, everybody gets that confused. The cookies are the actual investments, the single stocks, the mutual funds, which we don't want to do single stocks because they're pretty risky. You want to do mutual funds, REITs, ETFs, index, right? So those go in the cookie jar, right? So then Roth IRA, you can withdraw it at 59 and a half without being penalized. You can put $6,000 a year in there. So you can put $6,000 a year every year into the Roth IRA, $500 a month, dollar cost averaging, right? You break it down and then you invest it, and that's without a company match. Usually companies will match you 2, 3, 4, 5, 6% depending on the company. So you take that free money. That has to be traditional by IRS guidelines. The company cannot give you just free money. The government wants their piece. So you want to do a Roth, it's in you. And then the traditional money is the company match, which is fine, right? So then that's the first. Then there's a traditional, which we just went over there. Then there's a 401k. So an IRA is an individual retirement account, meaning you do it by yourself. A 401k means it's with a company. Okay. So a company, so you can put more money. It can also be a Roth or traditional. And then the 401k, you can put 22.5 last time I checked, and that money is also available tax-free at 59 and a half.
And those numbers change every year.
Exactly, due to inflation.
They should go up. Yeah. Every year. Yeah.
Because we want to put more in to get to keep the government, like, the hands off the
Yeah. When you're looking at companies to work for, definitely this is a benefit I would look for. And that match that Matt was talking about, that's extremely important. I think that'll tell you a lot about a company, how much they want to literally invest in you and your future. I think that's important when you're looking at just a company's benefits package, something to think about.
Exactly. So guys, so basically we're just going to talk about those three accounts. So you just have your Roth, which is your individual. You're setting it up with outside a company. 401k is with a company. And then you have brokerage, which a brokerage account is just a stock market trading account that you can open that does not have any age requirements. So the big difference is, like, if you have a Roth IRA, if you have a 401k, it's 59 and a half. If you just have a brokerage account, you can take it out whenever. The other disadvantage is the taxes. With a Roth IRA, the taxes go till the end, till 59 and a half. You get the money tax free. But with a brokerage, you'll have to pay taxes on that money. But the life hack coming in hot. The life hack is you get mutual funds or REITs or ETFs with low turnover because you only have a taxable event when they sell the stocks within the fund, right? So basically what happens is if you get a low turnover mutual fund and you put it in a brokerage account, then you put money into it. You won't have to pay taxes on the gains. You will have to pay taxes on the dividends, unfortunately, but the gains until you sell. And what does it mean to be a low turnover mutual fund, you may ask? Well, basically all that means is they don't sell the stocks within the fund often. So in a 401k, in a Roth IRA, it doesn't really matter because that's long term and the taxes are all fine. Like, you're protected. You have a little coat over your cookie jar. So, like, you have the cookies. The cookies are the investments. The cookie jar is the actual vehicle, either if it's a brokerage, if it's a Roth IRA, if it's a 401k, and then the coat will be over it is if it is a IRA, because you don't have taxes, it protects you from taxes.
Yeah, it makes sense to me. It's interesting.
So yeah, so basically that's that, and then so we have that. Now, and then the other type of accounts is college for kids. If you have kids, there's two main ones. It's called a 529 and an UTMA. So a 529 is like the college fund for kids. It's specifically for college. You put money into it, then at 18 they can access that for college, only college. And then an UTMA is a Uniform Transfer to Minors Act, which basically all that means is you can put money into the child's name, and then at 21 they'll get that, receive that money for like a new car or down payment or starting a business or whatever, if you choose to do that. So like I said, those are the cookie jar types, and then the cookies within the jar are the actual investments.
I'll just take real cookies.
Nice.
I know, seriously, all this cookie talk, I'm like, I'm hungry.
Want some cookies. Anyways, okay, next thing we'll go over real fast. The rule of 72. You guys know what that means?
I've heard that before. You're going to have to refresh my memory on what it is.
Yes, guys, this is a beautiful term. So the rule of 72 is the length of time for money to double by an investment return. Matt, what the heck does that mean? Okay, basically, let's say your average investment return is 10% a year, right? The stock market did 11.2. We'll just say 10. So that means you divide 72 by 10%, or just divided by 10, doesn't have to be percentage, which means 72 divided by 10 is 7.2, so that means every 7.2 years, your money should double.
Interesting.
Right? So like after...
That's not quick enough.
I know, right? Right, that's what everybody says, and nobody wants to wait. So like let's say you have 100K at 28 years old. Well, at 35, if you don't add anything more to it, it'll be 200K.
Oh, this is if you don't add anything to it.
Yeah, so if
I
you
get
don't add anything to it, if you add stuff to it, then it goes even faster. Then it gets crazy. But the rule of 72 just means how long does it take for money to double, right? So that's basically all it means. Then we'll go over the capital gains tax brackets real fast. So 0%, you don't have to pay any capital gains if you make between $0 and $40,000 a year. Now, I get a little bit confused if they mean earned income or the income from the investment, so check me on that. But yeah, basically there's three brackets. There's 0, 15%, and then 20%. So 15% would be 41,000 to 460,000, meaning you'd pay 15% on your capital gains if you made between 41,000 and 460,000, and then over 20%, it would be 20% over 461,000. So you'd pay 20% on your capital gains.
Seems fair to me.
Yeah. So guys, if you think about it, earned income versus investment income. Earned income is taxed at a very much higher rate than investment income. So what you want to do in like a logical sense is you want to turn every dollar you get from earned income into investment income, so it's taxed at a more efficient tax bracket, right? And then all this is doubled when you're married.
Smart.
Yeah. So all this is doubled. So multiply everything by 2. For you married people out there, multiply
Tax
all that by
benefits.
2. Then the next thing.
So if I have 3 wives, can I multiply it by 3?
Yes, you can. Well, actually by 4, because there's 4 of you.
Oh, hey.
Yeah. I don't know how the government would see that. The IRS would see that.
I meant 2 wives, not 3. My bad.
Okay. So then 3.
Yeah. Well,
so then you multiply
Still
it
don't
by.
know if that's legal, but
I don't know. I don't know if the IRS would be like jiving with that, but I don't know.
I don't think you can get legally married to more than one person.
I hope not.
I think in Utah maybe you can.
Yeah, right. The different types of investment firms you can actually go through to start these accounts, guys. So we have Charles Schwab, Fidelity, and Vanguard. Those are my 3 favorite.
Robinhood.
Yeah, I don't like Robinhood.
I do.
Okay, Robinhood's another one. But again, basically what these companies are is they're just giant financial institutions that you can put your money into, and then you can invest with them. And then, yeah, that's basically it. So, yeah. And then there's 3 different ways to buy a stock. So like when you actually go on the website and like buy a stock, you can do it in market order, which means you buy or sell at that current price. So like if it's $20, I want to buy one piece of stock, one thing of stock for $20. Okay. Then there's limit order. You buy or sell at a max or minimum price that you choose. So you say, well, I want to buy when it hits $25 a share. So then you put the order in. I want to buy when it hits $25 a share. Boom. Then it automatically would do that trading electronically. Then you have a price gap, which is stock market makes a sharp move up or down. So if it goes up 3%, I want to buy when it goes up 3%. I want to buy when it goes down 10%. I want to buy when it goes down 6.8% because that's when I think it's a bull market or whatever. But yeah, so those are the ways you actually buy. I recommend just doing market orders, just buying at the current price. Keep your life simple. Like you don't need to do all that other crap. If you're buying for the long term, it doesn't really matter anyway. Then there's a way to how to analyze like the actual investment. So there's a ticker symbol, which is just like Amazon would be like AMZ I think that's what Amazon
Yeah.
is, right? So that's their ticker symbol, and ticker symbol is just like the thing that the company name condensed for the stock market. Then you have your price per share, so that'd be like $20 a share, $30 a share. Then you have your year-to-date return, so it shows you a year-to-date, a 3-year, a 5-year, and then it'll say inception. Inception just means when it began. Yeah, and then there's the 52-week high and low. Basically, there's 52 weeks of the stock, looking at the stock market, like the chart, and it'll show you like what the high was and what the low was, just for your information. The turnover rate, that's important if you're going brokerage. The S&P 500 has a very low turnover rate, so that's a great fund to put into your brokerage account. That's what I have in my brokerage accounts, so that's kind of cool. Then the inception date, when it began. Shares outstanding, how many shares are in the fund. You have your expense ratio, which means what the percentage of expense it is to be in that fund. And then you have your net assets, which is the value of the asset. So if it's $1 billion fund, if it's $100 million fund, if it's $1 trillion fund, whatever it is, the value of the whole fund. Then you have your then you have your dividends, which a dividend is portion of profits. So if you own 1,000 shares and it's $1 per share, you get $1,000 every year of dividend income. That's what that means. Day range, and then the name of the company. So then you have compound interest, which is interest on principal plus interest. That's how the rule of 72 works, is like the money doubles like every 7 years or whatever the percentage of investment return you have. And then we're going to go, the last thing we'll do real fast is, we'll go over the different indexes. So there's a couple I wrote down. So there's the Dow Jones, which is 30 blue chip stocks, which just blue chip stocks are just companies that have like long track records that have been around, like ExxonMobil. I don't know why that popped in my head. ExxonMobil, Samsung, Apple, Amazon, whatever. Then you have the New York Stock Exchange is where all this happens, the activity happens. Then you have the S&P 500, which is the 500 largest companies in the United States that you can invest in. Then you have the Russell 2000, which is 2,000 small companies. And then you have the Wildfire 5,000 total stock market index, which is 5,000, just the total stock market, like 5,000 stocks in the stock market. So it gives you a broad overview of the stock market. Then you have the NASDAQ 100, which is 100 large companies in America. Cool. And then we're going to go over an example portfolio of how you actually tactically do this and set it up.
Let's see. Yeah, I've been wondering. Let's look at the application. I feel like we've gotten
The education.
we have like a bunch of definitions. Let's see how we can do it in real life.
Okay, let's do it. Let's go. Okay, guys. So we have an example portfolio of how we're actually going to start this investing if you do not invest right now. So basically what you would do, we're just going to use Fidelity as the example. You'd go to fidelity.com, the website, right, for all you tech nerds out there. Okay, so you go to Fidelity, you make an account, you put your social security number in, you put your address in, you put your date of birth, you put all that, like you're doing anything else. You put your social in, it's okay because it's connected to the IRS and it's for tax purposes. That's okay. Don't get spooked out by that. That's normal. And Fidelity is like a multi-trillion-dollar company. Like, it's fine. Okay. So you go to fidelity.com, you set the account up like you do anything else for whatever else you're doing on the internet, right? Then you create the different accounts you want. So in my opinion, you want to create a Roth IRA. And then if you're with a company, you can have a 401k. So usually the company will set up the 401k for you. So like, let's say you have a Roth IRA, you do an individual retirement account, you select that one. Okay, now you have the cookie jar, right? Now we have a brokerage account. Now we have another cookie jar.
Yeah, you can have multiple cookie jars, people.
You can, which you want to, because why would we put all of our cookies in one cookie jar? We want to diversify our portfolios, the nerds in the finance world talk about. Anyways, so we have a Roth IRA, and then we have a 401k if you have a job. If you're self-employed, just do an IRA. Then you have a brokerage account, which is another cookie jar. The difference between the cookie jars is the age you can access the money and the tax implications. So with the Roth IRA and the 401k, 59 and a half, then you're good. With the brokerage account, you can do any age. It's free to sell whenever you want. And again, how you get your money out is just selling, and how you put money in is buying. So you buy a stock, you sell the stock to get the money out, to get back into your bank account. Okay? Then now we have a Roth IRA, a 401k set up, and a brokerage account set up. Cool. Now, how are we going to fund them? that goes back to dollar cost averaging. So basically what you do is with the 401k, it has to come from company earnings. So it'll go straight from your paycheck into that account and be invested. A brokerage account you can automate through your bank. So automation through your bank, and then the IRA automation through your bank. So basically the logistical way this happens is the money goes from your paycheck into the account without you even knowing. Your company does it. Then the brokerage account, you literally just set it up. And then you put the money in on your request at the same day every month. So like, let's say you want to do it on the 1st. So you put 100, we're going to use some quick, easy numbers. So we're going to put $100 into a brokerage account on the 1st of every month, and it'll automatically happen without you having to do anything. Then we want to put $100 per paycheck into your 401k. So you put $100 per paycheck, $100 per paycheck. So your company did that. Then the brokerage account, you did it on the 1st of every month. Boom, you're done. You're good. Cool. Now you have your brokerage account done, you have your 401k done, and you have your Roth and you have your IRA done. Boom. Life is good. And it's all automated because it's just coming out of either your paycheck or your bank account, and it just kind of goes. Does that make sense?
Makes absolute sense. And it's, I think, easier than a lot of people think it is.
It is.
Especially because, with a 401k that's through your company, that's
It's
something
automated.
that you set up with them. They handle all the administration for you. All you have to do is tell them how much you want out of your paycheck. And like you said, it sounds like the rest of these options you can
Just automate
through your bank. So you don't even have to think about it.
So you literally just set it up once, and it's just recurring every month. The only part that you have to do, which I know this, you have to have the money there for it to go and to be invested. So that is like the
You have to have the
tactical-
money in the account.
You have to have the money in the account for the brokerage to take it and invest it for you.
Yeah.
Which you have a job, you're gonna work, you're gonna get self-employed, you're gonna start a business, you're gonna do whatever you're gonna do. But this is what happens after you make the money, and then you want to invest it into the mutual fund, into the into whatever. So then that just automatically happens, and you don't have to do anything. You literally, all you got to do, you go to the website, you create the account, you set all this up, and after that, you set it and forget it. You want to come back on? So guys, that's it. So basically, that's the tactical of how you actually do it. You have the money automated, and then I recommend you look at your portfolio probably once a quarter, 3 or 4 times a year.
Easy enough.
Don't look
Yeah, I
at
can
it
do
every
that.
day. Don't look at it every day. Don't be a
Don't freak yourself out because
Yeah.
it will go up and down.
If it goes down, be like, I want to buy more. If it goes up, I want to buy more. If it goes sideways, I want to buy more.
Yeah, because you're dollar cost averaging, so it
So
doesn't
it-
matter if it goes up or down because you're always
Winning.
averaging. Yeah, you're always winning.
So guys, think about it. If it goes up, I want to buy. If it goes down, it's on sale, baby. If it goes sideways, I'm buying. If it goes to the moon, I'm buying. 2008 happens again, I'm buying more. Because guys, everybody freaks out about, 2008, like we lost all our money. But it was like a 50% decrease in value. And then if you look at the stock market from 2008 to today, you 7 times your money
You got really rich.
if you left it in. But everybody was saying, oh my God, we're all going to die in 2008. No, you're not. You're going to be okay. And people are like, well, Matt, you're too young to understand that because you didn't have to go through 2008. You're right. But I did go through 2020. And in 2020, the stock market went way down. It was like 40% loss. And I was like, everybody's freaking out, selling all their stuff off. And I was like, no.
I lost a lot of money during that.
Yeah. And I did too, right? But guess what? At the end of the year, it was up like 60%.
Yeah, even through 2021 and 2022,
It
the effects of
went
COVID on the stock
crazy.
market were crazy decreases. And, at that time, I was taking customer service calls at my company, and we had people all the time calling in saying, how do I take my money out? And we're talking about retirement accounts.
A lot of money.
And, so our investment advisor, if you're not if you were trying to retire in 2021 or 2022, I'm sorry.
Yeah, that was
But
bad
if you're not-
timing.
but if you weren't keeping it in, that's what's great about the longer term investments is, like you said, even after 2008, a few years from now, even now versus where it was at in 2020, you're going to be making money at the end of the day.
Because even in 2024, I think that my portfolio is up like 8%. And we're not even done with the first quarter.
Awesome.
Right? So it's like, guys, think about this quote, okay? No one gets hurt on a roller coaster unless you jump off.
That one's going to
True.
stick with me.
Right? Because think about it, guys. You get on a roller coaster, right? And you're going upside down, you're going up, you're going down. Oh my gosh, you're screaming, you're scared, right? And at the end of the ride, you come back and you're like, "Oh, I survived."
That's a really good analogy for life, I feel like.
But like it's specifically for the stock market.
Yeah.
True.
Because people, what they do is they get in, they get out. They get
They
in,
freak out.
they do.
Everyone freaks out right away when their stock goes down $1.
They're like, "Oh my gosh, it's the end of the world."
They freak out. They say, "Oh my God, it's going to go down to $0." They don't realize that it's not, and then they sell it. They lose a lot of money. People like you buy it when it does go down. It goes back up because you're smart. You make money. You just got to be smart.
Yeah, if you just buy and buy and buy and don't sell, you're going to be fine. Now, guys, the next question is, so that's tactically how you do it is you invest, you automate everything, you look at it 4 times a year, you do not sell unless you have a specific reason you need to. Now, I suggest for like, this is not financial advice, but like for a brokerage account, the only reason I'd sell a brokerage account is to either buy like real estate, buy a business, or if you want to buy a car or like you want to go on a cool vacation. But like besides those 4 things, like I really wouldn't sell the brokerage account because I want it to keep going, because basically that's like your bridge account before 59 and a half if you want to retire. So if you want to retire at 40 and I'll give you an example. There's a lot of people out there who have $4 million in their 401k, right? And they have nothing else. And they're 40 years old. What does that mean? They can't access their money for another 20 years.
Without big penalties.
Without big penalties. So would you rather have a $2 million in your 401k and then $2 million in brokerage? Or would you rather have $4 million in your 401k? Which one would you rather have?
50-50.
Exactly. What? Now, don't you think that's logical?
Yeah, it is. And actually, a lot of investment advisors now, especially just because of the way that Social Security is going to look for our generation and all of that, it's just harder to save as an American. And for a lot of Americans, it's hard to take a certain percentage of your paycheck and put it into something that you can't touch until you're 59 and a half. That's hard for a lot of Americans. And so a lot of, investment advisors are suggesting that, yes, you do the 401k, but you're also doing other stuff with it that you'll use way down the road.
Before you're 59 and a half. Because you don't want to have all your money tied up in a brokerage in a 401k, because let's say you want to buy a business. Let's say you want to buy a piece of real estate. Let's say you want to buy that dream car and all your money is tied up in your 401k and you can't access it until you're 59 and a half. So for me, like I have my brokerage accounts and then I also have 401k. So you have your long-term investing and then you have your long-term investing, but not to the point of retirement, if that makes sense.
Yeah.
Right? So the example is like you put $100 into a mutual fund, you put $100 into your 401k, you put $100 into a brokerage account. So then you have like your IRA, your 401k, and your brokerage. So then not all your money is going to be tied up until 59 and a half. So you can have it more diversified when you can actually access it. Which I think that's what a lot of people can maybe do wrong, is because if all your money's in your 401k, that's great, and you're worth $4 million, but you can't access it for 20 years. So it's like, that's great, but like you can't.
Oh, well.
Yeah. So you want to have that bridge account of the brokerage to be able to live off that. If let's say you want to retire at 50 instead of 60, well, you need 10 years to eat. You got to eat for 10 years, right? So then if you have that, you have that brokerage and that IRA and that 401k, you have the diversification to be able to give yourself more options over time. Last thing I want to talk about, then we'll wrap up, guys, is the golden goose versus the eggs. And we got a lot of analogies today.
I don't know what that means.
Okay. So, guys, everybody says, well, Matt, if you're just buying and buying the stocks, like when do you sell it? When do you cash out? Valid question, right?
Well, when do you?
Yeah, that's a good question. So, guys, golden goose, golden eggs. Now, guys, in the stock market, the whole point of creating a portfolio is probably to live on it eventually, right? And retire, right? For most people, the normal average person. So the golden goose is the portfolio you're trying to build. So like, let's say, I'm gonna give you guys an example. I'll give you an example. So let's say you do $100 a month, just 100, from age 25 to age 65. I'm targeting people under 30 here that are just at maybe 22 to like 27, right? We have a demographic here, guys. Just hold out with me, like see where I'm going. If you start investing $100 a month from age 25 to age 65, it's 1.2 million or 1.1 million dollars or something, right? So that's the golden goose, right? Then it lays eggs. So then the eggs are the interest, the dividends, and the capital gains. So what you do is you live off of the golden eggs and you don't kill the goose.
You just continue to let it keep building itself.
Exactly. So does that make sense?
That's a good,
Yeah.
yeah, that's a great strategy.
So basically, you build the golden goose, it lays the golden eggs, you eat half of the golden eggs, and then you put it back into the golden goose so the golden goose continually gets bigger.
So it can make more.
And with inflation, you want to beat inflation as well, right? So then you build this golden goose, it lays golden eggs, and then let's say you do $500 a month. It's like 5.2 million. So like let's run the numbers. If you actually put the 500, which some Americans can't do 500, if you do 300, if you do 200, do something. So then you have money later. So like let's just say, for example, you do the $500 a month, age 25 to age 65, and you have to add, you can, and this is the cool part, you can average the 500 or 100. If you start at 300 and then you go up to 700 when you start making more money, and then when you're 37, you're making really good money, and then you do 1,000 a month. If you average, let's say you do 500, you get to $5 million, your golden goose. That's $500,000 a year of golden eggs at 10%. Right, just like a hypothetical, which is the average. So you have $500,000 that came off your golden goose. You live off half of that. You put so you have $250,000 a year, you 250 grand you live off of, and then the 250 goes back in your golden goose, which now is 5.25, and then the next year it's 5.5, and then it goes down to 5.3 because the market went down a little bit, and then let's go to right. So you see what I'm saying? Like you live off the golden eggs. You live half the golden eggs, then you put the other half back in to the golden goose so it gets bigger. That's why I say, well, Matt, when are you going to sell? It's when I live off my golden eggs and then I reinvest half and then live on the other half, which the bigger the golden goose, and also the bigger the golden goose, the less the market fluctuations matter.
Yeah, that's definitely.
Because if you have $10 million and it goes down 10%, okay, you have $9 million. If you have $1 million and it goes down 20%, you only have $800K.
True.
So the bigger the golden goose you build, the less you care about the market fluctuations. And people, oh my God, I got to sell. Well, that means you didn't have enough money in the market. If you have $10 million or $8 million or even $5 million, you're good forever no matter what. But if you have like $500,000 and it goes down 20%, well, that's a lot in your world, right? Because you don't have as big of a golden goose. But if you aim for 5 million, even 3 million, like that's $300 a month, you reverse engineer from the beginning to the end, or from the end to the beginning. So you put the $300 a month in, you have it automated, and then boom, and then over time you build the golden goose, they lays the golden eggs, and then you get to eat. So that's kind of it. So that's the return, and the 4% rule is like whatever their portfolio is, you try to live off 4%. So if it's $5 million, it'd be 250 grand. The example I used. So yeah,
I've heard that before.
yeah. So the 4% rule is like basically saying that's like your baseline of what you can live on without having to touch your golden goose. And I think people think bigger, like at least think 5 million, because if you reverse engineer that back to today, it's $500 averaged over 40 years. And most people can do that and can get into the position to do that over the next 40 years.
Yeah, I think it can overwhelm some people.
100%.
The idea of
100%.
like, oh my gosh, $500 a month, especially for someone our age.
It's a lot.
It's just a lot of money in general. I feel
It
like
is.
for your average American.
Facts.
But I think when you think about it, you know, it's the way that I'm approaching paying off my student loans. Is
Yeah.
like, hey, right now I can do $250 a month, but in a few years when I make more, I'll be able to do $500, $600, $700 a month and pay it off quicker.
Exactly. So like and another thing is the quicker you can free up the payments of like debt in different situations, then you'll have more cash flow to then be able to invest more.
Exactly.
Yeah. So if you can start with like $100, and we're not talking about debt today, but we're just talking about like investing. But if you can start with like 100, then you get up to 200, and then you can build that over time. Even if you just start at 100, just start somewhere, and then you can build it up to it. Because like if you can make a goal of like, I want to start with $100 a month, but then I want to get to $500 a month in 10 years, or $1,000 a month to then get that portfolio fat. So then your golden goose is fat, which lays lots of eggs, and then you can build that to the next generation, like when you pass
Yeah.
away.
Set something realistic.
Exactly.
Yeah.
Which I think realistic is 100 a month.
I think that's pretty realistic for a lot of people.
Because if you do $100 a month for age 25 to age 65 and never get a raise, you can get $1 million, 1.1 ish. And that's why my goal, I mean, 10 is great. That's my benchmark where I try to push people for them to see the opportunity and then like, okay, like you can build that golden goose, which then lays those golden eggs. But yeah, guys, so that I just like to show people that reality of like there's opportunity if you look at a long enough time horizon, you can be patient. And this is only one part of the piece. There's also real estate. There's private equity you can invest in. And then you can create a personal brand like I'm doing. Like there's so many different parts to building a successful financial picture and financial future for yourself, your family, and then generations to come after that. But yeah.
Just build a business, man.
Yes, sir. And then build a business. You can sell it, and then you can invest there too and invest the money. But anyways, any last thoughts from these two amazing people sitting next to me?
I definitely learned something today.
Hey,
Yeah, me too. I'm not the best. I can build a business, but I'm not the best at like doing what you do. So it's very different.
guys. And
Nice
in
to hear it.
the future, we can do one of these on real estate, and then we can do one of these on buying businesses. And Mr. Chase here has a lot of experience with selling businesses, and me, I do okay. He does great. She's great. You know, so I'm gonna do more of these. Like I want to do another one on real estate, and then I want to do one on private equity, and then kind of putting everything together with your I call it the perfect net worth.
I like that.
Ooh.
How to build a millionaire.
Yeah. Well, we're talking like 10 at least.
I feel like the finance is fun, or whatever we said at the beginning.
It was
Like make it accessible.
yeah, to everybody. I want this video to go to like as many people as I can get it to so they can watch it and learn from ground zero because
Yeah.
there's a lot of people in their 20s that know nothing about this, and I'm very passionate and I love communication and teaching, and you don't come around people usually who are good at communication, good at numbers, and then good at teaching and have those three traits together because most
True.
finance bros are nerds and can't communicate,
True.
and most people in accounting like can't do that either.
So moral of the story is today's lesson. Listen to Matt.
I do okay. I got a lot to learn though, guys. I got a lot to learn. Like I look up to a lot of people. Like I said, I've sat down with people with 6, 7, 8 figures in their portfolios, make 6, 7, 8 figures, and I'm very grateful that I'm doing pretty well. I'm doing okay myself, but you know, I know where I'm gonna be, and like you can get to $5 million net worth, you can get to $10 million net worth. You just have to like think about it, and like even $1 million, it's $100 a month. So start there. You guys can do it. We're all doing it. Life is
You can do
good.
it. You can do it. We can all do it.
Yeah, life is good, guys. But any last thoughts?
No, thanks for following along.
Yeah, guys. I hope you
Thanks
guys
for having
learned
us.
something.
I feel like there's no way they didn't.
Yeah. I taught you how to get rich, and this is just one part. There's real estate, there's private equity, and then there's the perfect
Make it a
network.
series.
Yeah, we're in the series, so this is episode 1. So yeah, guys. Well, this is it, guys. This is the finance episode.
Thanks, Matt.
Take care.
Have a good one. Bye.